And welcome to Cocktails and Commodities. And everybody listening, welcome to the ultimate crossover episode. Sitting in front of me is Nick Frappell, who we often feature together on The Pot of Gold. And Nick today is joining me on the podcast of Cocktails and Commodities. And the reason why we are doing this very special feature is both of us are at the Mines Money Connect Melbourne conference here in Melbourne. Now, I guess Connect Melbourne. I think I need more coffee. Nick, how are you? And thank you for this crossover episode.
Extremely well. Thanks, Shae. And no, thanks very much. Welcome. It's fun to actually be here and join in on this one.
Yeah, this is good. Look, gold is the ultimate commodity. So, of course, we wanted to have, as far as I'm concerned, Australia's best gold expert on to talk about this precious metal right now.
You're too kind.
Yeah. Now, listen, you and I were on a gold panel yesterday, and basically we were talking about some of the major things that are driving gold right now, and we are going to get to those in the second half of today's conversation. But first and foremost, I want to talk about what are the main, in simple terms, for people who are new to the precious metal, what are the main factors that influence the gold price?
Traditionally, the main one that's been the strongest and most sort of robust influence, durable influence, are real interest rates. And we take a look at those via Treasury inflation-protected bonds in the United States. And that's been a really good relationship. But I have to give a little caveat, which is that in the last 6 to 9 months, that relationship, regression relationship, has broken down a little bit. And the reason why, as far as we can see, is because there's been such large central bank buying, and particularly the last 6 months of last year, last 2 quarters, and even the first quarter of this year, there's been such big central bank buying, which has kind of happened irrespective of where real rates appear to be. That's kind of broken that relationship. But it is a really strong relationship, should come back. The other big relationship is the dollar. So often we talk about the dollar index so that we can talk about the broad, moves in the dollar without singling out particularly major currencies. But yeah, the dollar, euro, but the dollar index generally, which we call the DXY. So those would be the 2 big ones. And then it kind of becomes a little bit less, things like economic growth, crude oil, that kind of stuff.
Oh, awesome, Nick. Now, switching gears, let's talk about technical price movements. Now, I am ill-prepared as we lead into this conversation. I haven't looked at the gold price this morning. I do know, I know, ladies and gentlemen, the look of horror on his face.
No, we're at a conference.
Yes, it was a busy morning getting out the door. Now, obviously, yesterday, the US dollar gold price was hugging that 1950s level, and it has been there for some time, especially since the US dollar it ended with a whimper.
Yes.
Sorry, not the US dollar. Especially since the US debt ceiling ended with a whimper.
Yeah.
There was no real reaction. In fact, gold traded down into the US debt ceiling discussion being solidified a couple of weekends ago.
Yes.
Now, what is happening with managed money positioning? We'll get to some price forecasts in a second, but how is managed money positioned given that gold's got no real catalyst behind it right now?
Yeah, I mean, especially now that we've got past the latest FOMC, the latest Fed meeting, which we all know that the FOMC committee decided to pause for now. So managed money, which is effectively proxy for investor, or it is investor positioning, declined a little bit down to 12.1 million ounces long, not particularly long. Shorts declined to 2.76 million. This is as of the 6th of June. And that's actually a reduction of about, I think, 870 thousand ounces. So that happened on a fairly large dip. So the implication there is that the shorts made money by buying those positions back. And actually, if you look at the price history and the volume weighted average on the futures, it looks as though those shorts were largely established between $225 and $232. And they bought them back during the week ending the 6th of June at $1,977. So that was good, fairly well captured, that move from the shorts. The net result is that the net positioning for managed money is about, if I can read my own handwriting, about 9.34 million ounces. Now, just to give you a sense of context and perspective, the long-term average, and I think I did the average back to like 2006 or something, so it captures a lot of time, that long-term average is about 10.2 million on the net positioning. So we're just underneath the long-term average for net positioning. So you can draw a couple of conclusions, not conclusions, you can draw some inferences from that, which is that positioning is not particularly high, and that wherever you feel we're at in the gold market, gold investors via managed money are not super committed, they're not particularly undercommitted, and they're certainly not overcommitted.
That's actually a good take to have, because we did bring this up in a panel yesterday that while gold did take its third stab at all-time highs in May this year, it's only down about a little over $100 per ounce. So it hasn't completed a full retreat, and it does seem to be that there's strong technical support above 1,900 per ounce.
Yeah, if you look at where we are now in terms of, everyone has the different approaches to how they look at things technically. I look at a couple of things, so I don't kind of have paralysis by analysis, but I look at things via the Ichimoku clouds. So right now the gold spot price is just above the daily Ichimoku cloud base, which is still bullish and it's still supportive. That's 1936 in US dollar terms. Now the next support level below that is 1923, which is the weekly standard line. And then at some point below that, quite a long way below that actually, you've got the top of the weekly cloud. What is that saying? If you're still in the daily cloud and you went through from above, then that's still bullish on a, kind of like a medium-term time frame. We're well above the weekly cloud on the on the weekly, so that's also bullish on a medium to long-term time frame. If you look at the short-term time frame, it's a lot more questionable. And in fact, just looking at the gold price earlier, on a weekly basis, we've been following the gold up in this big sort of weekly trend channel. It kind of came near the top of that channel when it sort of peaked around about in the 2050s, and then now it's like in the 1940s. It's actually really threatening the base of that rising trend channel. So short term could be under a lot of pressure, and I think that speaks to some of the discussion around about the Fed's activities yesterday, overnight. So that's part of the sort of the pressure that gold's under.
Nick, I feel like we're a well-oiled machine, because I'd really like to talk about what the Fed did overnight. That's just a great place to lead me into where we're going. Now, we're going to skip silver today. I feel like silver's sort of a nothing story.
Yeah.
It's tied to copper, relatively speaking, and hasn't done anything that's exciting.
Yeah.
So silver fans, I'm sorry, we'll come back to it.
Silver's having a tough time, I think, because China's still at that kind of really not a very impressive post-COVID, post-reopening sort of activity. And I think although China, I'm just going to talk a little bit about this.
Yeah, sure, we're here now.
Whilst we're here now. Although clearly there are policy decisions, you can see the PBOC is sort of reducing various rates, trying to pump a bit more liquidity back into the system, because they're seeing that things are beginning to drag. And it goes back to that whole conversation we've been having for about a year and a half now about particularly the Chinese real estate sector being a drag on Chinese consumption, Chinese growth. Now, the reality is that things are pretty slow. The recovery is pretty slow in China. Policy decisions are being made, but it's not really moving the dial as yet.
All right. Well, that was a wonderful recap of silver, and I always love it when people talk about silver. Nick in particular has been trading the precious metals market for a considerable period of time.
Yeah.
And silver
Lots of grey hair.
What did you tell me? You were 2 bear markets and 1 bull market old in gold?
Yeah. Maybe 2 bull markets. I don't know.
Time will tell.
Yeah.
All right. Now let's get back to the Fed. Now, in the lead up to the Fed decision, the Fed CME Watch tool was very convinced that the Fed was going to pause.
Yes.
And I did find a wonderful quote in the lead up to the Fed decision last week from, I believe it, Philip Jefferson, I think his name is. I wish I had my notes in front of me right now for that one. And he made it clear that if it was a pause, he wanted the market to remember that it was not a change in policy direction.
Yeah.
And then a subsequent Fed official came out and said, please think of this as a skip.
Yes.
Now, the Federal Reserve did as expected last night. Last night our time, they did keep rates paused. However, Nick, this is sort of a well-worn topic of ours, the persistent disconnect between narrative and what the Fed are actually doing.
Yes.
So have you had a chance to go through the Fed meeting minutes from last night, and do you have any views that you'd like to share about what the Fed did? Or
Not in
Fed's
their
doing?
entirety, not in their entirety, but I can
It was a late
offer
night.
some. Yeah,
We
I can
were out for
offer
cocktails, quite literally. So
exactly. But I can offer some thoughts. And the thing is that in essence, although it was a skip and the Fed did pause or skip, the reality is that they have conveyed that the tightening bias is still very much in place, and that there's perhaps unless data changes, that there's a couple more tightening events in the pipeline, at least of 2023. So the language that came out was slightly complicated. I guess the aim was to maximize flexibility around what the Fed can choose to do depending on how economic data emerges. But a couple of the things that are sort of important, that median Fed expectations for the highest level of policy rates, 5.6%, which is high.
that's got to be higher than the last time we discussed this.
It is. Yeah. And I hope I didn't take these notes too quickly and wrote down something from like another central bank. But if you look at the futures expectations of policy rates, those are maxing out at 5.28% of September. So there is still a kind of a disconnect, still quite pronounced. Now, one of the other things that came out of the discussion is that whatever you think the policy rate is going to, the Fed funds rate is going to sort of maximize out at, there was no concept or no thinking at the FOMC that there would be cuts during this year, the remainder of this year, which I think is really important because was very different to what the market was pricing in, over the last weeks and certainly a couple of months since the Sovereign Bank and Silicon Valley Bank and sorry, not Sovereign Bank, Silicon Valley Bank and the First Republic and all of those things. So that's a pronounced difference, and that also I think there was a hint that. Or not a hint, but some wording around this being quite a long period before the pivot to lower takes place. So this is a really, really different kind of narrative to the one the market was pricing in, say, April, post the kind of bank shock that reverberated through the system. So again, and that goes back to where gold is now. That there might have been a pause, but a lot of the language and a lot of the expectations are this is tighter and higher longer. And we've had this conversation so many times, and I actually gave up like 3 weeks ago. Eventually, like you get taken to the point where you think, oh, okay, I was wrong. But actually, it is still a world in which higher for longer, unless there is the onset of a really pronounced slowdown or evidence that the Fed has got inflation truly under control and back to the 2% mandate, and that is just not visible right now.
Look, for anybody who is new to Nick's analysis, Nick has been talking about the higher for longer narrative since the middle of last year. So you've really been ahead of the curve on the pivot's not coming. This tightening cycle is intense, and and you've been one of the very few commentators in this space putting that out there. So Nick's well on record about this, but I do want to touch on inflation in the US because it is proving to be sticky. It's not going anywhere. So I find it impossible to believe that a few hard rate hikes higher are going to get inflation down to 2% at the end of the year.
Yeah, it is hard to believe. And I think just going back to what you said, I mean, I don't know when I started banging the higher for longer drum, and I'm obviously probably following.
Pretty sure it was August last year.
Yeah, so the point is, I guess, when there was that first thought of a pivot around the end of last year, I didn't really believe it. So that was definitely the point where I kind of had that higher for longer thing. But yeah, going back to the inflation thing, and look, I haven't really split out all the different components, but if you look at sort of core CPI, there certainly seems to be some evidence that it's persisting, and sort of shelter and so on, things that matter because they're not just going to change over the course of a month, or you wouldn't expect them to change over a course of a month or even a quarter. Those things are those things are problematic. and likely to carry on. And also sort of switching away at a different way of looking at it. I made a presentation recently. Well, I think it was in May actually, and if you look at what policy rates, suggestions around policy rates should be via, say, the Taylor rule for central bank policy rates, then Taylor rule suggests much higher rates in America. This is just much higher rates here too, by the way. So there's a really big gap between where policy rates are now and even policy rates where they would be, like if we went to 5.6, we'd still be short of where the Taylor rule suggests that the Fed should have the Fed funds rate. And why are we not there? Well, because I think the political and economic ramifications of actually converging on the Taylor rule would be pretty horrific, the social ramifications. But also it's partly because although policy rates and Taylor rule kind of like have followed each other at times pretty closely, there is a tendency for when the Taylor rule says ease, central banks are quick to ease. When the Taylor rule says hike, sometimes central banks are like, maybe not. And that's because, giving people, I guess to use that Alan Greenspan kind of analogy, going to the punch bowl and dipping deep with the ladle and filling your neighbor's glass with easier money is always a nicer feeling than locking away the drinks cabinet. So anyway, sorry.
All right, Nick, let's touch on the Aussie dollar, because up until a couple of weeks ago, the Aussie dollar was taking a little bit of a beating, but it's starting to show some signs of life. And I just had a quick look at my chart here, and it looks like it's trading at almost 68 cents to the US dollar.
It is.
So, look, I like this sudden surge of strength because I'm off into the US in about 5 weeks. So I really needed the currency to pick up. But what are the factors moving the Aussie dollar right now? And please tell me, will the momentum be sustained?
Well, I think that we're at a fairly critical level with the Aussie. I'm not sure if the low is like just around about 0.65. You've got the chart sort of like more visible in front of you.
I do. Yep. Look, actually, I think there's the old trader in you coming out. Yep, bang on, bang on.
65, and that's fulfilled a couple of technical targets. I think we had technical targets 64.90 and 65.11 on the trusty point and figure. So that kind of fulfilled some pretty important downside targets, because the Aussie at 65 is as you say, it was taking a bit of a beating. So what happened since? And I'm not going to go into a huge amount of detail on the Aussie or Australia generally, but I think there's been two key switches in emphasis, and one is that the RBA, the expectations around the RBA and the sort of tightening cycle, which I think as recently as a couple of months ago, some people might have thought had come to an end, even though Australian inflation, as elsewhere, was still persistent. But the reality is that, well, the Fed, Federal Reserve Bank of Australia, the RBA actually came up with a quarter percent rise last week, and it looks like they've got scope for two more. And if you look at the futures-based policy rate expectations, if I looked at it correctly earlier on, it looks like peaking out, the expectations that is, have the RBA policy rate, the official cash rate, peaking out at 4.5% November of this year. That's pretty high, and it's more pain. But what it does mean is it's positive. The interest rate, the policy rate, more positive for the Aussie dollar. That's one thing. Second thing is this, and this may have helped prompt along with the RBA decision, it's fairly good short covering in the Aussie dollar from the non-commercials futures sector. And I hadn't had time to really break it out into those sort of other different kind of disaggregated participants. But let's just say that collectively in non-coms, there was notable short covering. Probably more buying from that than anywhere else. So that is also coming from the direction that I mentioned earlier, which is China taking policy steps to boost the Chinese economy in 23. Yes, probably the Aussie and Aussie traders are because there was a certain degree of pessimism around China. Not surprisingly, although China-Australia trade relations are sort of kind of on the definitely on the mend and improving. In fact, as we looked at the Chinese economy as a whole, the bigger picture didn't look that great, but that's improved some degree, and the fact that the PBOC, for example, making efforts to ease and inject liquidity and ease policy rates, that's probably been taken as better, an improvement in the outlook for Chinese Australia trade. So that's it.
Look, that's a nice, neat summary there. So I do like that. Now, Nick, as I said, this is the ultimate crossover episode. And I know you've got to go check out of your hotel very quickly. So we are going to wrap this up. First of all, I have two questions. Now, What is your key takeaway from this chat for investors? Is this a gold discussion that we're having, or is this an interest rate discussion that we're having?
I think it's always an interest rate discussion at heart. But yeah, look, it's gold. When we spoke on the panel yesterday, and I kind of wanted to say something right at the end, because we had that discussion around where gold was going, and all the panelists were super bullish.
Yes.
With the proviso,
I wasn't bullish enough. I got booed.
Yeah, but then and that. Well, okay, I'll say something about that as well. The reality is, and one of the other panel members made a really important point, which is that, and this would apply to all of our bullish forecasts, is your question was specifically about the end of the year, but our forecasts were kind of more, this is where we think gold's going to go, irrespective if you give us a time restriction. So that's probably the kind of the thing that has to be borne in mind. What you said at the end, which was not as nearly as bullish as us, I think was a much better interpretation if you include if you're more mindful about the fact that the end of the year is only 6 months away, and given all the pressures and the tightening cycle we've referred to, your conclusion, I think, was probably the wiser one. And I kind of wanted to say that because I didn't think that was sort of well enough understood, or wanted to make that point about the fact that we haven't got that much time. It may be June, but we haven't got that much time to get to some of the big numbers, 22, 23, $2,400 numbers that all of us were saying on the panel. The other thing is, actually, and I wasn't going to mention it, but you did mention that you got a mild boo from somebody for not being bullish, and I just think that's like, asset prices go up and they go down, and sometimes they go sideways. But booing people because they don't say something you like is incredibly crass.
Look, first of all, to hear an incredible trader like Nick, back my view into the 6 months of the year, I actually really appreciate that. I'm all warm and fuzzy on the inside. And I do agree with you. To be fair, everybody did put out some great numbers.
Yeah.
And I think while my question was clear, everybody wanted to put forward, no, we're long-term bullish gold. I'm very long-term bullish gold.
Yes, exactly.
I'm very excited about what's ahead for gold and gold-related equities for people who like to play the market that way. But I was looking specifically to 6 months. Just as I said, I knew it was a loaded question when I threw it out there.
Yeah.
Now, Nick, speaking long-term, and obviously there are many technical targets that need to be broken to get through. Would you like to share what your long-term forecasts were that you revealed yesterday?
Well, I think the way I put it was that if we can get above 2075, which is this kind of like a triple top now, then that opens the way for a move, and I'm not, obviously can't be held to the timing, but targets up to 2350, $2,400. And that was consistent with what the other panelists said, actually, which is kind of funny. We all got very similar looking targets. But any asset market needs a kind of a catalyst or an additional impetus for that to happen. One of my points was, and this isn't necessarily the thing that takes it through 2075 or up to 2400, is that I'm still a believer in the secular decline of the dollar in terms of it relative to other currencies, not don't want to go down this rabbit hole, but not de-dollarization. That's a completely different story and not relevant. But just the fact that I think the dollar, and interestingly enough, by the way, just circling back to what we said about gold levels, what's really important is if you look at the dollar index, it bounced off the top of the bounced off the base of the weekly Ichimoku cloud. That's key resistance. And so far, it has moved up there. It's bounced off. I think it was a key Fibonacci level as well. We actually talked about this, I think, a couple of weeks ago.
Yes.
I think we did bring it up in one of our pot of golds.
Yep.
So that again kind of underscores the sort of it'll move up, it'll move down, but the general secular decline in the broad dollar. And then the other thing that I mentioned was that if there was volatility, banking stress, systemic stress, and alarm created possibly, not saying it will, but possibly out of the Bank of Japan's exit from yield curve control, which is something I've been talking about on and off, for the last quarter or so, or last half year maybe, as a potential. I'm not sort of forecasting that it does this or it does that, but if you look at it as a potential source of stress, depending on where the world is when, and the BOJ Governor Ueda is keen not to create any stress for obvious reasons, but that point will have to be addressed at some point. I thought it might be addressed by Q4, but it might be Q1 of next year. So that's trying to give you an idea, and to give the listeners the idea of the stuff we were talking about yesterday in terms of an additional catalyst or motive force that would help push gold higher.
It was a very nice summary of what was a quite extensive panel. Now, Nick, before you go, as I said, the ultimate crossover episodes. So Pot of Gold listeners, you're about to learn a little bit more about Nick.
Yeah.
Now, here at Cocktail and Commodities, we like to know what everybody's favourite cocktail is. Now, I know you and I did indulge in a couple last night.
Yes.
But Nick, if we were going out to a bar tonight, what would be your cocktail of choice?
I generally like a martini or actually a variant on the martini, which is a Gibson, which is a martini with some seed pearls. Seed pearls. What am I talking about? Must have had a Gibson just before I walked on. A pearl onion or pearl onions. Yeah, those are really nice. The pearl onions give a slightly oily and briny, oily and distinctive added flavor to the martini. In the absence of pearl onions, I'll go for just an ordinary martini. But we had aviators last night, and I've never had an aviator before. But it was a gin-based drink with some kind of violet flavor in it, and very masculine. I liked it.
That aviator tasted like 2 could very quickly become 5.
We
called it a night early on. Now, Nick, I do want to thank you for being here. I love your insights. Now, for anybody on Cocktails and Commodities who is listening today, if you would like to hear more about Nick's technical method of analysis, go to abcrefinery.com/resources/media-articles, and you'll be able to learn a lot more about Nick's method of technical analysis. It's quite unique. However, it's an extremely good predictor of price movement. I'll also provide a link to his analysis in the description box. Nick, you've got to go check out. Our time at this conference is drawing to a close. For Pot of Gold listeners and Cocktails and Commodities listeners, Nick, thanks for being here.
Thank you, Shae. It's been great.